US economy shrinks in first quarter of Trump 2.0. Amid sweeping tariffs, the US economy shrank in the first 3 months of Donald Trump's second term as the president sought to roll out an aggressive trade strategy, claiming that sweeping tariffs on the world would strengthen the US economy. Gross domestic product, GDP, a key measure of overall growth in the US economy, fell by 0.3% in the first quarter of the year, down from 2.4% in the last quarter of 2024. 24. The contraction, the first since the start of 2022, puts the US on the brink of a technical recession, defined by 2 quarters of negative growth. The drop in activity comes amid a huge fall in consumer sentiment, which in April dropped 32% to its lowest level since the 1990 recession. Trump spent much of the first quarter threatening and fleetingly implementing sweeping tariffs on Canada and Mexico and targeting China with higher duties on its exports. Days into the second quarter, which was not covered by today's GDP reading, he ordered even higher tariffs on goods from much of the world, before pulling back the tariffs on all countries but China. As it stands, Trump is charging a 10% universal tariff on imported goods from much of the world, along with a 145% tariff on imports from China. Seemingly responding to deep fluctuations in the US stock market, Trump has shelved a wave of so-called reciprocal tariffs of up to 49% on specific countries, which he halted for 90 days. He offered some relief to US automakers, who were facing a 25% tariff on all auto imports on Tuesday, signing an executive order that would allow them to receive a credit if they import auto parts. But last week, stocks rallied on news that Trump said tariffs against China, which already has exemptions for some electronics, will be reduced substantially as the White House negotiates a deal with China, though Trump said that the tariff will not be eliminated completely. China has placed a 125% tariff on American goods in retaliation for Trump's tariffs. While the White House has said in recent weeks that Trump's tariffs are meant to be a negotiating tactic, leaders around the world have said they will retaliate if Trump continues to try to bully them into negotiations. If one chooses to remain silent, compromise and cower, it will only make the bully want to push his luck more, said the Chinese Foreign Minister Wang Yi on Monday. Trump has been sensitive to criticism of his tariffs and the impact they are having on the economy. At one point over the last month, Trump threatened to remove Jerome Powell from his role as chair of the US Federal Reserve, after Powell said that Trump's tariffs could lead to permanent price hikes. After markets fell, Trump eventually backed down, telling reporters that he had no intention of firing Powell. So here is some great information to keep in mind. California's economy is now the 4th largest in the world. Or is it? Gov. Gavin Newsom was quick to announce that California's economy ranked 4th in the world, but maybe he spoke too soon. Eric Thayer, Associated Press. Forget the wildfires, earthquakes, water shortages, and all the other factors that place the California dream in doubt, according to pundits. Governor Gavin Newsom has some good news, citing federal and international statistics. California has just moved up a notch to become the world's 4th largest economy. That happened because the state's gross domestic product was measured at $4.1 trillion as of the end of 2024. 4. Eclipsing Japan, $4.02 trillion. All that stands between California and the top spot are the United States, $29.18 trillion, China, $18.74 trillion, and Germany, $4.65 trillion. California isn't just keeping pace with the world, we're setting the pace, Newsom declared in announcing the latest figures from the Bureau of Economic Analysis and the International Monetary Fund. Our economy is thriving because we invest in people, prioritize sustainability, and believe in the power of innovation. Newsom made some good points in his announcement, citing the state's national leadership in high technology, agriculture, and access to venture funding, among other spheres. But he also voiced a cautionary note about the Trump administration's reckless tariff policies, which are already pointing to a steep downturn in imports landed at the ports of Long Beach and Los Angeles. California isn't just keeping pace with the world, we're setting the pace. Governor Gavin Newsom's word of California's somersault over the fading Japan generated coverage in newspapers coast to coast, cable news, and even as far afield as the BBC. None of this reportage, however, addressed the most pertinent question about the feat, which is, so what? Some of the reports did qualify California's ranking by acknowledging that it would be germane if California were a country, not a state. But they didn't go very deeply, if at all, into why that should make a difference. So let's take a closer look. I gave a short answer and a longer one. The short answer is that the issue of whether a state can secede was settled permanently in 1865. The long answer is that California, for all its economic primacy, is not only tightly bound with the entire domestic US economy, but its role in international trade is also dependent on federal trade policies, for good or ill. We can see the effects of that at the ports. Traffic grew by leaps and bounds over recent decades due to the explosive growth in trade with China and Southeast Asia, even though it's currently threatened by President Trump's preposterous tariff war. Despite its size, California has discovered that it can't go it alone on many important goals. The state was unable to enact its own universal healthcare insurance system, a goal of then-Gov. Arnold Schwarzenegger. It can't finance its state-level health programs without billions of dollars annually in federal funding. In normal times, its universities are the largest recipients of federal research grants. Never mind that those are threatened by Trump. He won't be around forever. In February, Newsom asked Congress for nearly $40 billion in emergency funding for relief in the wake of January's devastating Southern California wildfires. One reason for circumspection is that the international rankings are notoriously squishy. They're dependent on numerous factors that may have less to do with economic growth as such than with factors such as currency exchange rates. Indeed, the main factor in California's leapfrogging over Japan was the decline in the yen's value against the dollar, an artifact of the Bank of Japan's decision to maintain low, even negative interest rates. Since national GDP is typically calculated in dollar terms, that hurt Japan in relation to its nearest rival in the rankings, Germany, even though Japan's growth rate in GDP in recent years has actually exceeded Germany's. Nothing about all this ensures that some combination of factors in California or the rest of the world won't rejumble these rankings, perhaps to the state's disadvantage. The last time I wrote about California's international ranking, in 2003, most news reports placed the state 5th, but some placed it 6th or even 7th. At that time, China didn't rank in the top 5th, though it was scuttling upward. The year before, California had fallen to 6th from 5th because of currency fluctuations. Another source of squishiness is the disconnect between raw GDP figures and the standards of living in individual countries. While California enjoys a high GDP, it dissipates the effective purchasing power through high and increasing costs of living, the California Center for Jobs and the Economy observed after the latest announcement. California's economy outranks those of Texas, Florida, North Carolina, Tennessee, and Utah, despite those states' supposedly business-friendly environments. Federal Reserve Bank of St. Louis. C. Federal Reserve Bank of St. Louis. There, however, we run into trouble assessing how those factors actually do affect growth. That's because those assessments tend to be encrusted in partisan ideologies. Consider a couple of state rankings based on their supposed friendliness to business. The Best and Worst States for Business, published by Chief Executive Magazine, and the Alec-Laffer State Economic Competitive Index, published annually under the title Rich States, Poor States. Both rosters purport to explain why some states grow faster than others. Neither does a very good job of it. In fact, both are very bad at it. The Chief Executive rankings are based on, naturally enough, a survey of more than 650 CEOs and business owners. In the 2025 edition, Texas and Florida rank 1st and 2nd, and California ranks 50th. 3rd and 4th are Tennessee and North Carolina. The top-ranked states earned their positions in part by having right to work, i.e. anti-union laws, and low corporate tax rates. Texas has no corporate tax at all, and the others range from a maximum of 2.25%, North Carolina, to 6.5%, Tennessee. Texas, Florida, and Tennessee don't tax personal income. California is dinged for not being a right-to-work state and having notoriously high taxes. A top rate of 8.84% on corporate income and 13.3% on personal income. The Alec-Laffer Index is more granular. Its top 5 states, in order, are Utah, Tennessee, Indiana, North Carolina, and North Dakota, with Texas at number 9 and Florida at number 15. California is down in the dungeon, at number 47, besting only New Jersey, Vermont, and New York. What do the index authors look for? Utah has a top tax rate of only 4.55% on personal and corporate income, no estate tax, a rock-bottom minimum wage of $7.25 an hour, and a right-to-work law. Texas, in addition to having no personal income tax or estate tax, has a $7.25 minimum wage and a right-to-work law. Florida gains by having no personal income or estate tax and a right-to-work law, though it's punished a bit for having a $13 minimum wage. One assumes that the authors of the Alec-Laffer Index, including conservative economist Arthur Laffer himself, held their noses in laying out California's dismal business environment. There are those sky-high personal and corporate tax rates, though California charges no estate tax, a minimum wage of $16.50, and no right-to-work law. If these rankings are of any value at all, they should be reflected in economic strength. They're not. In fact, as I've reported in the past, there's a negative correlation between a state's ranking in the Alec-Laffer Index and its economic growth. Economist Minxia Chin of the University of Wisconsin noticed this a few years ago, prompting him to label the index a manifestation of faith-based economics. I asked Laffer to comment on the gap between the index and reality, but didn't hear back. Many of the categories tracked by the ALEC Index aren't drags on a state's business climate, but reflections of its appeal. California is downgraded for its cost of living, which is reasonable enough, but it's expensive in part because it's a desirable place to live. The state with the lowest cost of living is Mississippi, but who wants to live there? Yes, there are lots of regulations in California, but that's because some of the features that draw people in, such as its natural beauty and its climate, need safeguarding. That leaves us with the most reliable measure of a state's economy, the size of the economy. On that metric, California, for all its problems and costs, leaves the rest of the country in the dust. California's economy is about 1/3 larger than that of the second largest state, Texas, and nearly 2/3 larger than Florida's. The gap between California and those two states has even widened since 2009, the end of the Great Recession. North Carolina, Utah, and Tennessee are barely large enough to occupy the same chart. What this all means is debatable. If Californians wish to bask in the sunshine of having the strongest and most durable economy in the nation, so be it. But that's not an excuse to ignore all the headwinds that might face our economy in the short term, that is, under Trump, or the longer term, when global warming, water and housing shortages, and other contributors to the cost of living will need to be solved to keep the California dream alive. California doesn't need to think of itself as an independent nation to have pride in what has been built here. The factors that have made the state so big and rich are still mostly in place. Among them are an intellectual and financial infrastructure that makes Silicon Valley and its entrepreneurs the envy of the world, the largest commercial market in the nation, which makes this a place that retailers and service providers can't ignore. A wealth of natural resources and a landscape of such beauty that it beckons multitudes. Isn't that enough? Thanks for watching A Voice Podcast News. Please hit the subscribe button to support the channel. We appreciate it. See you in the next video.